So the first thing I'd like to do is talk a little bit about who am I. Okay, so instead of tooting my horn, let me talk a little bit about how many times I've had the dickens kicked out of me so you can take me seriously. Maybe I can talk about how I lost $2.5 million when I had 5,000 orders in my e-commerce supply chain gone. Maybe I can talk about how I made the mistake of, I used to consult for large restaurant chains and I thought I should open up my own and gained 70 pounds and almost had to file bankruptcy. Let me talk about the thousands of people that I've hired in my career for my companies. And the point is, we as entrepreneurs get so focused on marquee acquisitions, marquee sales, all these folks making hundreds of millions of dollars, okay? But what we don't do is get down to the basics of what the normal entrepreneur is. And I've spent almost 2 years of my life figuring out how entrepreneurs self-destruct their own value in their businesses, okay? And I have a book coming out called Exit Bomb, which is namesake of this workshop today, and it'll be released at the end of the summer, and some of the concepts I'm sharing with you will be in that book. A couple of other points of note. I moved to Oregon about a year ago. I am the CEO of an M&A advisory called Rare Brain. We're locally based, and I live locally, so I'm a phone call away should you want to reach out to me. So let's talk a little bit about why I'm here. I have two agendas. One, I wanted to reach out to other local companies. But secondly, my cause, some people have pets as a cause, some people have children as a cause. My cause is entrepreneurship. And the reason is because I'm 45 today, and when I was 24, I was recruited into EO. I spent 15 years, almost 15 years in EO. During that term, I had about 4 or 5 exits, 5 exits, I think, in EO during that tenure. I'm the past president and board member of the Houston chapter of EO. I've traveled all across the world with EO, going to Hong Kong and New York, New Orleans, and all these different universities and GLCs and so forth. So I understand the mindset of the entrepreneur, okay? And that's why this is not today designed around an academic exercise. These concepts are complicated, and my job is to kind of simplify them. So let's move on today. So let's talk about, I'm gonna bore you with 2 statistics that I think are very important, okay? Imagine you lived in a neighborhood and almost every second home went on sale. So if you live in a neighborhood, there's 600 homes, 300 homes go on sale. What happens to the value of your home? That is exactly what's about ready to happen in the United States, because 63% of all businesses in America are owned by baby boomers. 63%. More than 1 in 2 businesses. The oldest baby boomer hit 68 years old. Okay? So imagine what's about ready to happen. Every time baby boomers have gone into an industry when they were children, they kind of disrupted the toy industry. When they started buying homes, they disrupted that. Everything they have touched has been disrupted. This phenomenon has never been seen before. We've never really had a business sale inventory problem in the United States before. 63% of all businesses. And they need to exit within the next 50% say that they will exit within the next 5 to 10 years. 75% said they will exit over the next 10 years at the most. So the point is, you need to be really aware of what's coming over the next 5 to 10 years. I don't care how good your business is, your multiples are going down. And guess what? Entrepreneurs 20 years ago, they did not have to deal with it. 3 other things I want to share. We already have a problem. And this is probably one of the most important statistics I'm going to share with you today. And this is when I was talking about we get so focused on who sold their company for 100 million. Let me give you a startling fact. 80% of all businesses in the United States that are listed for sale do not actually sell. So if I hold that to that statistic, 8 out of 10 of you, when you list your business, you will not end up selling for multiple reasons. And I will get into why. 70% of all family businesses do not transfer to the kids. And the third, Price Waterhouse did a recent survey. 3 out of 4, i.e. 75% of business owners actually have sellers or more within 1 year of selling their business. So it's not a good picture. We already have a problem. Is that the exit bomb? No. Exit bomb is what's creating a lot of these issues. So let's get into it. Now, if you'll notice right here, I'm using words like detonation. And I know it sounds funny, but by the time I'm done, it's not going to be funny. So let's start with exit bombs made up of 4 detonations. First detonation is at the entrepreneur level. Okay? It starts with us. What I feel, what my motivations, influences, personal and psychological factors are, what my knowledge gaps are, that creates the first detonation, and we bring it to our business. Where the second detonation occurs, internal value destroyers of the business. We end up building a business around us. One day we drop dead, our business drops with us. That's called over-reliance. It's a great value destroyer. Or we want to control and micromanage our business to the point that our business just cannot grow, or we get scared, or we have our own ceiling of complexity. All those, or we have operations that don't work. Internal value destroyers, second destruction. Third is at the market level. These are external value impactors, some that you control, some not. It could be your competition, or it could be market activity based on consolidation, pushing your values up or down. Fourth is at the buyer and third party level. This is what I call, this is kind of where the things start getting really serious. This is what I call disruptors, killers, and reducers. Essentially, these could be adverse findings during due diligence. It could be your landlord decided not to renew the lease. It could be simply you found out a major revenue recognition issue and your price is getting adjusted, or you hadn't disclosed something, and so forth. So now you are at this level. So what's going to happen? 80% are at that failed exit line. If you'll notice right here, there is this sale line. If you are lucky enough to cross this, okay, which is 2 out of 10, you hit here. And this is where I'm going to spend a lot of time today for those people that have actually sold it. I have this category called post-exit shockers. These are all the gotchas. Okay? I mean, these are tax surprises, everything that happens after you've signed on the dotted line. Okay? So that creates the exit bomb, and that's what the book's about. So let's go under the hood. Detonation 1, personal, psychological, knowledge gaps of the entrepreneur. So here I'd like to tell you, and this is, if you don't hear me for many other things, just hear me on this. Everything that we are wired to do as an entrepreneur, okay, it works against us from an exit perspective. Everything, except maybe 1 or 2 things that I'll get into. So here, we are risk takers. We'll bet the farm, or most of it. We'll borrow on credit cards, start our companies, go sign personal guarantees. When it comes to selling, loss of objectivity as it relates to risk. It's kind of like we're driving a car really fast. We feel we are in control, but our passengers are to the point of paralysis. Their experience is entirely different. Here's another one, problem with authorities and rules. I am one of these people. It creates the mindset, I am in charge, I need to be in control. We don't make the best employees post-exit. We don't stick around. We do not fulfill our post-closing obligations. We do not have our earnouts materialized. Okay? Again, destruction of the entrepreneur. We like to be in control, need to be involved in all the details. Over-reliance on the entrepreneur. And I keep saying, $10 million business, if you're creating value, great. One day you drop dead and the business goes with you. That's almost 8 out of 10 businesses in America. They just don't pass on. So those are the personal elements. I'll do a couple of others. I mean, I have a couple of sheets here. Fear of failure. Okay, there's a mindset called a day with positive cash flow is a great day. I go with that. Okay. The problem with that is there's so much focus on cash flow, we forget to build value. Another one is we're true believers, almost to the point of being narcissistic. We drink our own Kool-Aid. My product is the best. My product is the best. My product is the best. Guess what? You're not open to criticism when it comes to sale. So the buyer's essentially trying to critique you, and you're getting very, very personal to the point of getting really upset. So those are some examples of the personal elements. So let's talk a little bit about psychological elements. Exit motivations. Whether you're burnt out, whether you need money, whether you're coming to retirement age, or whether you have grown your business to the maximum possible, You're either running away from your business or running towards something. So I've kind of grouped these things. Here's an example of sprinting away from your existing business. Market landscape's changing, you want to get out. You've got a skill gap issue. You've taken your business as far as you can. Could be you've got business problems, cash flow issues. You don't have internal successors. You're bored. You're burnt out, and so forth. Again, everything is running away from the business. Towards the next chapter, you want to start a new business. Philanthropy. It could be you want to simplify your life, personal financial needs, health issues, so forth, age, retirement. So the best time to exit, by the way, and I'll cover this in the second part of this session, the best time to exit is when you absolutely don't need to exit. If you hit any one of these motivations, it's almost too late to harvest value. Think of it another way. Imagine that you know that your body has cancer. Okay, so instead of dealing with it when it's early stage, this is stage 4 cancer. If you get here, you're already gone. You're already mentally checked out. You're a human being. So the deal with this is best time to exit is when you don't want to, and it needs to be focused on value with a careful eye to milestones and market activity along the way. And I'll cover quite a bit in the second session on this. So psychological elements, motivations is not just what's impacting it. There's exit decision influencers. So in Portland, I arrive in Portland, and guess what I hear everywhere? Triple bottom line, B Corps. In Texas, that's where I'm from, you don't hear about B Corps. You know, you're about, pardon me.
I'm sorry, I don't know what that means.
Well, thank you so much for asking. So triple bottom line is not just about, typically the entrepreneur is all about profits, profits, profits. So the triple bottom line is about people and environment as well. So it's about sustainability. So it's the concept of buy local, grow local, eat local, buy sustainable. So it's about environment, all that kind of stuff. So, and the question was, what is triple bottom line? And that's what I was just answering. So in that kind of scenario, that's not a bad thing, but it will limit your pool of buyers, okay? But there's some things that are outright bad, like hearsay. You're playing golf and your neighbor says, you know, my buddy sold his company for 17x without regard to what industry they were in, what value it was. Hearsay impacts you. You've got, you know, life and world events happening. It could be business legacy, and I'll cover some of these in the next slide. My business is my baby. You know, don't call my baby ugly. This is what I was talking about earlier. The moment the buyer says, well, you know, this is not working and this is bad, you're getting all pissed off at the buyer. Nepotism, little Bobby's involved in the business, and dad says, unless you can employ little Bobby or my key employees long term, I'm not going to sell to you. And as a result, the pool of buyers restricts down to 1 or 2, or most of them walk away. Legacy is when you don't want your products, your name changed. You're sort of all about the legacy entrepreneur. What is my legacy? So it's more than just money. So these are kind of examples of decision influencers that are beyond motivations. Then comes our knowledge gaps, okay? And these are exit-related knowledge gaps. What is my actual valuation? You know, I have an idea, I think I do, but what is my real? Am I in touch with reality? What is my valuation? And this I'm going to cover a lot in the second session. What builds value in my company and what adds risk in my company? Net proceeds. How much money will I actually walk away from after everything is adjusted? And I find that this is a real wake-up call for entrepreneurs because generally they have very little idea of what their actual take-home would be. They oversimplify it and it's not simple. Reality I'm going to cover in the next slide, but alignment that's another interesting thing. Is if you think about it, most entrepreneurs, I will bet you 80 to 90% of the people in this room have 80 to 90% of their net worth in their businesses. Our businesses are our biggest assets, okay? However, one, we don't know what their true value is. Second, we haven't aligned our personal finances with the business. So when we go to sell, we don't really know how much money we need versus what we have, modeling it out versus how much money we need for our next chapter, whether it's retirement or otherwise. And as a result, there's this rude awakening at the table, okay, simply because we haven't aligned with something that's 80 to 90% of our net worth. So the financial planners are operating in a cocoon, and the business owner is kind of keeping these two buckets separate, and they're really not. They're very interconnected. This is also another one, expertise. There is a false illusion, and this false illusion is very much to the detriment of the entrepreneur. You guys know your businesses. I know my business very well. Okay, I know my numbers, I know a lot of different things, I know my customers. So it makes me feel like I'm expert in my business. But the reality is when you're exiting, you're anything but. What's happening is the buyers are buying businesses, many businesses, multiple transactions in a year, over multiple years, and we are selling a business once in a lifetime. And there is this expertise gap, and entrepreneurs just have a very natural job to be confident. And we get confident, okay, and it comes to bite us where we don't want it to. So that's another key problem that I see with the entrepreneur. It's overconfidence because they think they're an expert around their business when it has nothing to do with actually being an expert in the exit. So here's reality that I want to cover. Time frame wise, how long does it take to sell my company? How long will my company be in the market? What's required in preparation? What will be required of me? What will be required of my key employees? What should I expect? How much cost should I allocate to prepare and get my company ready? When should I begin? And so forth. So, you know, nobody teaches us how to become entrepreneurs. It's not college level really courses. I mean, we kind of learn along the way, and this is something that just never gets covered. Let's go to detonation 2, internal value destroyers of the company. People, owner issues, declining performance, products, services, non-proprietary products, weaknesses in operations. I mean, it's pretty obvious stuff. I'm going to cover some of them. We are so good at putting out fires that we entrepreneurs are great firefighters, but I'd like to tell you that I think that we're arsonists, okay? Which is why, exactly, we are the one who's setting the fire. So I keep talking about the guy with a $10 million business, or I'll ask you what, okay? Here's a simple question. Everybody literally drops dead today. Whose business will survive here? Just raise your hand. Okay? So there you have an example. Is the bulk of the room is not, some of you say you will. Congrats. But the point that I'm trying to make is we are so busy fighting fires, dealing with cash flow, dealing with customers, dealing with people taking our customers, you know, just all this stuff that happens at the same point, trying to manage our personal life, family life, the banker, the investors. I mean, it's like we've got so many hats. We forget to work in the business versus on the business. It's kind of a classic case of not being able to really build value. And so much so, it's that the point about the Grand Canyon factor, you will spend more time planning a family vacation to the Grand Canyon than you will on your exit, okay? And that's why when you do a statistic, 75% of entrepreneurs have not done any exit planning. Why? It's 80% to 90% of your net worth, okay? We already know by the time you get to motivations, it's too late. You know, so what stops us? And it's that over-optimism. Again, one of the exit things where I was talking about earlier. Over-optimism destructs our value. Concentrations. This could be customer concentrations, supplier concentrations, employee or key employee concentrations. This is where one customer drives more than 20% of your revenue, destructs your business. You have a hard-to-replace supplier in your supply chain, lowers your value. You've got one champ key employee, one day has a heart attack or decides to go to your competitor, your business goes down, destructs your value, increases risk. Financial visibility. We're running lifestyle businesses. We want to run little Johnny's laptop through the company stuff, take a family vacation, run it through the company. You know, we do all kinds of different things. Some of us run it clean, some of us don't. But commingled account, books not getting closed on time, there is not enough financial visibility into our financials. And it's the buyer comes in and they're looking at it. It's like buying a house and you don't know which wall has termites, but you know has termites. So as a result, you lower the value of the house overall because or the period of time for due diligence stretches out.
Okay.
Yes?
You've mentioned the term value several times, and I get what you mean in a generic sense. Could you be specific about when you say building value, could you define that?
Yeah, actually my second part of my session
Okay.
is there's about 15 slides or 10, 15 slides on actual value. I was asked for those watching on camera is to define value, and I'll be doing that in the second session. And that's a big part of, it's common that I get that question, by the way. Thank you for asking. Let's talk about detonation 3. Now, I'm going to not take that much time on it, but this is everything from the baby boomer factor I was talking about. You've got $4.5 million, 4.5 million businesses coming for sale, $10 trillion of transfer of wealth, and it's never happened before. Okay? So that's a business sale inventory issue. Market activity could be an important element, of course. I mean, this is out of your control. Competition, actually, let me do it on this way, is market triggers that you still have to watch out for, even though you don't have to worry about market activity as much. Market triggers are where there's legislative changes, or there are changes that the cost efficiencies of your business has changed, or it's created new opportunities, there's consolidations going on, and you see something happening within your business. Cost of capital, that's another very key factor. I will tell you, if you go out and do a valuation, traditional valuations do not take into account a buyer's cost of capital, okay? And it's the dumbest thing I've ever seen in my life, okay? It's like no connect to reality. And what I'm saying is, imagine is that you're going to go buy an asset, and somebody says, I want $1 million for it, but interest rates are sitting at 15%. He's not going to get $1 million, and you're not going to go borrow $1 million at 15%. So my point is the cost of capital, if you tried to buy a business in 2008, 2009, when the financial crisis was going on, there was no money to be found. Multiples went down. So the buyer's cost of capital is directly relevant to the multiple you will receive. Competitive discount. You can't control your competitors, but you can be aware. Your competitors come up with a new model, disruptive technology, new way of pricing, new service offerings. All of a sudden, you've got a huge issue because you've just gotten a huge discount on your purchase price because of your competition. This could be foreign competition, globalization, you name it. Supply and logistics, you're buying raw materials, hard to get, hard to source, freight costs go up, last mile sitting in customs and so forth. Did you have a question? Okay. So this could be another thing that could really impact your value. Let's talk about the real stuff. So I have taken the buyer level and put them into 6 buckets: money, deal, time, scrutiny, external, and humans. And let me kind of open that up for you. Deals relating to deal structure, terms. Time is the biggest killer of all. This is where you're sitting in due diligence and you ask your accountant for financials, and the accountant's busy with tax season. He comes back 6 weeks later, and by the time the buyer's agenda has changed and they found a new company. And so time is kind of one of those things. Adverse findings. Most of you can actually read this, and I don't want to read the slide for you, but it kind of lays it out. Let me cover the most important parts. When you think of price as an entrepreneur, okay, I do, I mean, I've been prone to this, we want to get the highest price, okay? But what happens is, with the price comes some C4. So think of a sheet that has an offer, and it's got some C4 attached to it, okay? What's C4? Think of C4 as consideration and terms. This is where you've got onerous terms. Consideration could be contingent, like they want to pay you the bulk of it in an earnout. Maybe they want huge seller notes with seller financing. Maybe they want to essentially transfer all kinds of risk to you by putting 40–50% of the purchase price in escrow and stuff. So if you've got a huge offer, it means nothing, because if you sort of take the consideration and terms into account, it could really blow up on you. So you need to sort of think of price as attached with some C4, and you want to understand what that C4 is. Because very rarely do you get 100% of your cash up front, and you don't get to walk away in the sunset. There's a lot of exposure still left, which I'm about ready to explain. Let's talk a little bit about structure and why buyers' taxes matter. And this is also very critical. So, who are buyers? So let's start there. We talk a lot about buyers. So let me take you back to when you first started your businesses or when you were looking for investors. These buyers are investors. And what are they looking for? They're looking for a rate of return. How are they going to get a rate of return? One thing that they're going to do is they're going to get a rate of return in 3 ways. Number one, they want tax advantages. So think of, do you really want to give a donation without getting a tax benefit? Maybe you do. A lot of people wouldn't. So why would they want to buy a business if you cannot get a tax benefit? Okay? That's number one. So you want to have an optimal tax structure. And that's the difference between an asset sale and a stock sale. The second thing is, I have to stop and I have to laugh because I was not expecting a dog to walk into my presentation. I just thought it was really cool. So anyways, that's great. I think that's great. So the second part is what the buyer wants is to pick and choose the liabilities that your business has. They don't want to be stuck with your legacy liabilities and your taxes. That they're going to pick and choose the liabilities. And the other point of this is that they want to be able to bifurcate certain assets from other assets. So if you've got an operating company and they want to buy a division, they want to be able to take a division. So tax benefits, picking and choosing the assets, and then picking and choosing the liabilities is why structure matters. So as a result, I will tell you that 70 to 80% of all business transactions in the United States are actually asset sales. Okay? Why does this matter to you? Well, if you're an S Corp versus a C Corp, it's a huge issue. A C Corp, if you're an asset sale, in Oregon, you'll pay somewhere between 60 to 70% in tax. Let me say it again, 60 to 70% in tax. C Corps, okay? If you're here in this room, come talk to me afterwards because 60 to 70% in tax. First you pay at the corporate level, then you pay at the shareholder level, and then you pay at the state level. So I don't understand why people have C Corps, and when they do, it's typically because they're envisioning a stock sale, and the only time somebody will buy your stock is if you've got some hard to get license like FDA or some regulatory license that is hard to transfer and it's very valuable and the buyer doesn't care. But generally, they're going to want to buy assets. If you're an S Corp, you're in a tax neutral situation or a flow-through entity, but if you've depreciated your assets, you're going to have a huge problem in the sense that you could have depreciation recapture. So let's talk about, again, why do buyers' taxes matter? They're investors. They invested in your transaction. They want a high rate of return for their investors. So by getting tax benefits, in their transaction in the early years, they're increasing their rate of return. Okay? So you want to now, 3, 5, 10, 12, 7 years prior to your exit, focus on, are you in a tax neutral structure or are you going to do your tax planning at the closing table? Again, 80 to 90% of net worth on the table. Why do we want to give Uncle Sam 60% of our net worth? I'd rather not sell. Okay? So let's also talk about what I call the risk game. So when we go to sell our business, we're not selling our business. When we're negotiating with the buyers, you guys are negotiating price. The buyer is negotiating risk. Let me say it again. They're not, I mean, you think that the buyer is giving you an offer of a purchase price. Forget about it. That's just money. What they're really doing is negotiating risk. So let me give you an example of, and this is about risk allocation. So buyer comes in. So let me kind of list about $10 million. Oh, I'll give you 35%, and then the rest of the 75%, I want you to finance it for me. Transfer of risk to the entrepreneur. Oh, yeah, you want too much for your money, since you want 10 million? Fine, I'll give it to you. I'll give you 4 up front, 2 in a seller financing, and the remaining 4, I'll give it to you as an earnout. Transfer of risk to you. Oh, by the way, yeah, we don't know what's going to happen post-closing, so 20% of the purchase price, let's put it in escrow holdback of some kind. Transference of risk to you. Oh, We'll pay a certain amount at some point in the future, transfer of risk to you. Recently, AT&T bought DirecTV, and that deal was contingent on DirecTV getting their sports Sunday tickets from the various networks. If they don't get it, the deal falls apart. Contingent consideration. So the point is, it's all about risk allocation. Other thing is reps and warranties. They want to be insured against under-reserved liabilities, undisclosed liabilities, outright misrepresentations by the entrepreneur. You're buying a house, you don't know where the termites are, and that's exactly what's happening in a business. Okay? And you need to be prepared for it. So if you think you're getting an umbrella exit, you're walking off, on the beach, you may be on the beach, but you can get clawbacks. You can get that phone call, and I'm about ready to get into the post-exit shockers, okay? But it's not getting just a hearing about reading in the newspapers, I sold for $100 million. One, it doesn't happen every day, and if it does, it still has a lot of strings attached. So let's talk about another key factor, the difference between valuation and worth, okay? So valuation is preliminary, and it's subject to adjustments. Worth is that valuation adjusted for deficiencies, errors, liabilities, and risks. So let's take it in a simple example. We're selling our home, and we list it for $1 million. And the buyer comes in, they're going to get an inspection done. Okay? So the appraisal that you got was for $1 million. Your realtor says sell it for $1 million. You list it, buyer comes in, you've got an offer, inspection happens, they find all kinds of different things. They come back saying, look, you got termite issues, you got foundation issues, your carpet sucks, whatever, and it ends up we need a $120,000 adjustment to the purchase price. That's exactly the difference between valuation and worth. What the buyer at that point is saying, I don't care about your appraisal, this is what it's worth to me after I adjust for your deficiencies, errors, liabilities, and risks. And here's the big rub. Entrepreneurs really don't know what their deficiencies, errors, liabilities, and risks are until they get to the closing table. They've got great books, so they think. Maybe they're not looking at industry standards. Maybe they're not looking at revenue recognition issues. They've got smart CFOs, chief operating officers, but they're not in the business. They're not in the business of divesting companies. And a lot of times, I find a serious disconnect of how the accounting is happening, and there typically comes all kinds of red flags come out. And the really well-run companies, by the way, in many cases. Let's talk a little bit about third parties. Most of us don't think of third parties when we're thinking of selling. So these are landlords. They may not renew a lease, may become a problem. Maybe they have to approve the new buyer. Maybe they don't like the buyer. Maybe they don't like what's involved. It could be regulatory, it could be FDA, it could be lessors, it could be banks, and so forth. So they also can kill or disrupt or reduce the value at an exit. Now, detonation 5, and after which we'll take about a 10-minute break. So these are the shockers. As you can see, I've put them in some very interesting buckets. No one told me, I hate this, headaches, what the heck, I got screwed, and they got my savings. And it sounds quirky and funny, but I was actually trying to get the entrepreneur to focus and notice what I'm saying, because this is kind of dry material. So really, what I've then gone in and reversed into what that actually means and backed into it. And I'm going to get into some of these. So they want my savings leads to legal and financial exposure. You're off in the sunset, and you can get your money clawed back. You can actually lose your nest egg, whatever you have outside of the business, if you're not careful. So classic example is, let's say that you manufacture belt buckles for baby seats. And all of a sudden, your belt buckle is at the center of a controversy that's millions of products are going on. So what's happened is the people that bought you use your belt buckle in their supply chain. Millions of units sold, and you don't have proper indemnification provisions in your contracts, and as a result, they come after you for $50 million, even though they paid you $10 million. So you've got all kinds of different financial exposures, and the words are representations and warranties. How many people have heard this word before? Okay, so fair amount of people have heard it, but representations or warranties are Buyer's insurance against undisclosed liabilities, under-reserved liabilities, and misrepresentations by the entrepreneur. Okay? That's their insurance. And against that, they're going to have escrows and so forth. No one told me. This I'm going to cover on the next slide. This is the tax surprises and net proceeds. We don't last with our employers. Our headaches from payment defaults to when we provide financing, there's third-party lenders involved when we end up in a second-tier position. Could be that we don't have liquidity. We sold 60% of our business to a private equity firm. We held on to 40%, and the company is growing great. We're making triple the profits, but they're not giving me money for my taxes. Liquidity crunches, those kinds of things happens all the time. Seller's remorse, loss of identity. My business is my baby. All of a sudden, this is my identity. I lose it. One day I'm dealing with vendors, customers, suppliers, employees. Next day, nothing. Okay? So it could have a real loss of fulfillment, creates a lot of seller's remorse. I always like to tell entrepreneurs, think of yourself as if you right now you are a battleship, think of yourself as the mothership, okay, instead of a battleship. A mothership has lots of battleships underneath, and if one battleship goes out, the mothership is intact. Take on a super identity rather than an identity. And the super identity would be you're the entrepreneur who is an investor that builds multiple businesses in their lifetime, and this current business of yours is simply an asset, nothing else. Okay? Now, I'm not saying don't worry about your employees and don't do things that matter to you, but what I'm saying is your business is nothing more than an asset. Your business cannot continue. It may continue, in fact, but your ownership of that business will not continue. It could be death, divorce, disability, bankruptcy, sale. This business may continue 100 years from now, but I promise you, you may not own it. Okay? So think of it as an asset. Take on a super identity. You want to be here. And, you know, your life's identity, you could build 20 more businesses in a lifetime. So might as well kind of take that step. And once you do, you end up getting in more of a return on investment, you know, a net return on assets mindset. And that will kind of change a lot of that environment. Let me cover a little bit. And this is probably the most important slide of at least this track. And this is the last slide, too. That's why it's here. So let me ask you guys a question. If you needed money, where in your business, not personally, where would you look? Help me out. AR, accounts receivable, okay? Where else would you look for money if you needed to liquidate money out of your business? Pardon me? Cash on hand, okay. What else?
Bank loan.
Okay, let's say your bank loan's tapped out. So far I've got cash on hand and accounts receivable. Pay your vendors slower. Okay. Let me add a couple more. You could have, if you have a work in process, maybe you slow down your work in process. Maybe you have inventory, you buy less, start liquidating existing inventory, squeeze cash out. Okay? As entrepreneurs, when somebody asks me, where is your cash? And if I need to make a business move, I'm looking at AR, and depending on the business you're in, I'm kind of looking at, depending on if I have a business with inventory and so forth, I'm looking at those things, okay? However, this is the biggest problem of all, and this is the biggest rude awakening, that when you actually sell a business, especially a lower middle market or middle market business, you don't get to take your receivables, your inventory, any of that stuff with you. You leave all your cash behind. And what you'll find is that when you see a typical letter of intent, it'll say, we are prepared to offer you for a cash-free, debt-free transaction. Something in those words. Cash-free, debt-free. So and that's actually kind of true, but to get you to understand, I have come up with some layman's terms. So I've split it up into buyer's cash versus seller's cash. Buyer's cash is reasonable working capital that you've had in your business the year to 2 years prior, the average of working capital. Your cash is any excess over reasonable working capital. So if you had an extra $5 million sitting in the business and you can say, hey, we really average working capital is $3 million, you could potentially take that extra $2 million out, okay? But most of us, this is where the problem comes in, is that we're not running our businesses efficiently. So there's a lot of different traps, and I'm going to take you through 3 or 4 or 5 of them that could be real eye poppers. First, how is sellers' cash determined? How do they come up with, your businesses are running enterprise, right? So think of it as water running through the pipes, and you don't want any disruptions because you got to pay the bills, collect them, you got to just continue to do it. So what happens is that they come up with something called a working capital hurdle. And so when you are negotiating a purchase and sale agreement, they're going to say, okay, our working capital hurdle is based on a target working capital amount, and here's the formula based on average 24 months, or if you're cyclical, here's the amount of cash you've had in your business, here is receivables, here's your accruals, here's your inventory, and so forth, okay? And that's the amount you actually need to leave in the business. So if you are one of those people that like peace of mind because you had a disrupted supply chain before and you're carrying a bunch of extra inventory, or maybe you're just lazy or you don't have really good purchasing systems and you've got a lot of that excess inventory, you get to leave it behind. You didn't need to. If your business needed to operate with good lean inventory worth $500,000 and you've got $1 million, one, you've reduced your EBITDA line down, but secondly, you've just left that entire $500,000 on the table, okay? Just so you know. So that's part one. Part two is if you are really speed paying your accounts payable, you're the world's best person to do business with, you fast pay your payables. So all of a sudden, when the buyer comes in, working capital is defined as receivables, inventory, payables, and accruals. If you got a little to no payables, you've kind of subsidized your own working capital, okay? Which can also create your own purchase price. Just like you did with the inventory, $500,000 too much inventory, hey, you just reduce your own purchase price down, kind of give your $500,000 to them, which they will liquidate after post-sale. Same thing goes with accounts receivable, and this is the key thing. Please hear me on this, okay? This will happen to every one of you. So what happens is when they say, okay, I need $2 million worth of working capital you agreed to, they'll give you a 90% credit to your 0 to 30-day receivables, 75% credit to 60-day receivables, 50% credit to 90-day receivables, okay? And nothing beyond that. So if your customers are slow paying you, okay, you needed $2 million, but your and let's say if it's only receivables, that $2 million, you're really only getting $1.5 million towards that other $500,000 comes in the form of a purchase price adjustment post-sale when they have reconciled the P&L, reconciled the balance sheet, and you get this call saying, after giving you a credit for all this stuff, oh, by the way, you're $500,000 short. Or you get a call like, hey, in your inventory, 30% of your inventory was obsolete, and we looked at your components, we can't repurpose it, $300,000 problem, okay? And it ends up with a magnifier effect, it creates a huge, huge problem. So there's all kinds of different surprises coming down the pike, okay? So then comes the tax games. Your advisors will sleep in the wheel, and a lot of accountants, by the way, they're not M&A tax experts, by the way, okay? The tax code's broad enough, I don't blame these folks, it's just that they're not M&A tax experts. So what ends up happening is that you may have all of a sudden, the buyer will take your purchase price and divide it into multiple categories. And then they will allocate to those categories to their tax advantage. So they'll go in and say, okay, we want to try to get as much into equipment category because we get a 3 to 7 year depreciation cycle, we can write this sucker off. Or goodwill is 15 years. Or they'll allocate it to, when they allocate to equipment, and if you've depreciated your equipment above and beyond its cost basis, you get an ordinary income tax event, and you find out after the fact. Or they'll allocate a bunch of compensation to no compete, which ends up being ordinary income tax. Or you've got an earnout that's not structured as consideration, but it's structured as compensation. So when you collect your earnout in the future, maybe it's 40% of the purchase price. Instead of you paying 23% tax rate on it, you end up paying 50% tax rate on it. So those surprises happen all the time. Or, as I said earlier, you've invested, you've sold a part of your business for a second bite at the apple to grow it and sell it as a part of a bigger company, and they're not giving you taxes on the profits. So, next point is the net proceeds, which I've been threatening to talk about. So, this is another important element. Let's say that when an entrepreneur gets an offer, this is something how they think. I got a $10 million offer, so I got about a 20% tax rate, I got $1 million in debt. Okay, I'll walk over with $7 million. Okay, that's good, I'll accept your offer, that kind of thing, right? What they're not thinking about is that C4 attached to the offer. So, what ends up happening is that 35% is in cash, okay? The rest is sitting in seller notes, earnouts, escrows, some kind of deferred payment, or some kind of contingent payment in the future. So first of all, there's a big low cash amount. Second part is that what we forget is that first we've got to pay our taxes, and then we've got to pay our debt, okay? Another big problem. Next, which is something that I am telling you, most entrepreneurs I wish that they would focus more on this issue, is the exclusions. So like I said, the buyer is going to come in, okay, and they're going to pretty much assume all operating liabilities and leave all the non-operating liabilities for you. Operating liabilities benefit them. Non-operating liabilities benefit the seller. So they're going to leave everything from payables, employment claims through date of closing, trade payables through date of closing, your seller guaranteed debts, leases, all those kinds of things. Could be past taxes, state taxes, and certain things. They may leave all of that on the table because they're not buying your company, they're buying your assets. They're leaving you saddled with all that stuff. So when I refer to this as a headache, so when you actually get your money, one, you're getting a lot less. Second, you're paying more in taxes, especially if you've got tax surprises. And then you've got all these headaches and exclusions to deal with that you still got to deal with. Yes, ma'am.
So I dealt with this situation firsthand, and my accountant, what we did is at the end of the year, we went cash basis. It's just a flip switch. And it helped me personally on the taxes, but my business is run accrual based.
Right.
So that's a great way to save on the taxes.
Right. So, I was talking to somebody else here, and I ran this way for my company too. We actually were a cash-based taxpayer, but we actually kept our books on an accrual basis. Frankly, I did it for lines of credit because, it shows the bank that, your AR and, it shows you a different picture to the bankers versus if you're running on a cash basis.
The way the bank wants to see it.
Exactly, exactly. So, again, two sets of books in this case. Thank you for that. And the big part in closing on the first session is that all of this is happening, it is happening post-closing. You have no control. It's a binding deal. You've signed a purchase and sale agreement. It is done. Most of this is happening when you actually have already received a good portion of your money, but they're holding on to a fair amount post-reconciliation. Okay? So the point is, the time is to kind of plan for it way in advance. Okay? Go ahead.
Is it possible, we were approached to be purchased, and I couldn't believe the terms that, in essence, we were financing the purchase for them and the earnouts and everything else they had wanted to do. Is there an expectation that some of those have to be attached? Like when you get, you're always going to have a piece that's an earnout, you're always going to have a piece, terms that are, I guess my entrepreneur.
No, you don't always have to have an earnout. Okay? So let me explain an earnout a little bit differently. Okay? And just so, and I'm going to cover some time on it, but I'll just take a stab at this now. Let's say that you've been developing a product in your company for the last 2 years, spent a lot of money in R&D, and you feel really bullish about your company. Okay? And you think that your company is going to double in the next 2 years. And at this time, you're going out on the market to sell. Seller comes in, they want to buy your opportunity. You're saying you're going to double and you want a lot more money. They're saying, you know what? I kind of buy into what you're saying, but I really don't know what's going to happen. I don't want to cut a carte blanche check to you, and neither would you. So let's bridge that gap. In comes an earnout. We'll pay you based on a formula at some point in the future based on performance. Okay? The problem comes with the earnouts is that you typically are not in control and how you structure it. So typically I advise people to structure an earnout on the top line, then maybe at the gross margin line, but anything below a gross margin line, if you do it, you really better spell it out, because the buyer's going to come in and saddle it with a lot of expenses, debt, and and you won't be able to. And another thing I notice is that sales is in one division and they left you with marketing, or finance is in one division and in your company is sales and marketing, and so they left you in control of your sales and marketing but not in control of the purse, so you're not in control of your own destiny. So most earnouts don't materialize unless you're very, very savvy how you structure them. So, and no, I would tell you, were you dealing with multiple buyers or just one buyer?
We weren't even selling. It was one buyer who approached us, who said, we think we would love to buy you out. Let's talk. And we shared financials, and they said, yes, we're definitely interested. And they presented terms and money, and I just laughed, because I would have no control to meet the goal that they would say would have to be met in order to earn what I wanted. And I said, I don't know, once the business is yours, what you're going to saddle it with exactly.
Yeah, so I want to also cover, sorry, go ahead.
No, that was it.
I'm going to cover this, but I'm going to cover it, okay? So this is meant for the room. One of the biggest value destructors of all is a single buyer, okay? So the classic thing is, you're single, you go out, you meet a nice girl, she seems pretty, you're talking, you have a couple of drinks, you build some rapport, maybe some more time spent, and you really kind of want to immediately, you're kind of loyal, and you want to kind of take yourself out of the market, okay? And you just want to kind of explore the possibility, all right? That may work great in the dating world, but it's the kiss of death when you're selling your business, okay? And the reason I'm saying is because when I'm working on the buy side with a client, and the client said, hey, Gower, I need company, between 20 to 50 million in revenue, 2 to 7 million in EBITDA, these are kind of gross margins, what I'm looking for, this sector, this part of the United States. When I find the right company, I'll boil it down from 15 targets down to top 3. I want to get all top 3 under a letter of intent when there's no other buyers there. And why? Think about it. Only reason is because we don't want competition. If we have competition, what happens? The price goes up. Either we are in a no-win situation in that situation. Either we're going to end up paying too much, or we're going to walk away feeling really bad having spent a bunch of money, wasted time and effort in due diligence. So either way, we don't win. So the age-old tactic, especially with private equity firms, call you up, take you out on a date, woo you a little bit, have a couple of glasses of wine, you're feeling all good, they're giving you all this stuff, and boom, you've taken yourself out of the market, checked out, and you want to create some competition. My best advice to you is, if you're in that position, get yourself out in the market, period. And get yourself, and I'm not saying, you don't have to shop like active, there is a private M&A process you run. Certain target companies need to be approached. And if they already know there's a buyer on the table, moment they find out there's another buyer involved, or even the hint of, your purchase price will go up. It's natural. So let's talk about how do we diffuse some of the issue. Now, please take it into account that I can't accomplish miracles in 45 minutes or 50 minutes that I allocated to this. So, but I'll try to do, this is a very complex area, as you well know. So let's talk about what we talked about, when do we exit our business? So 3 things that you want to look at. The older you get, the lower the value of your business. Why? Losing vitality. You may not want to stick around with the buyer. Buyer wants you to stick around 3 years. You're tired, 73 years old. Your spouse is saying, let's get the heck out of here. You promised to take me to Australia, and you just checked out, right? So age is a huge factor in, and also health issues start, so forth, unfortunately. Second part, business stage is very important. Whether you're an adolescent business, a startup, growth, maturity, decline stage, would really matter. Of course, the time to sell your business is when you're 100% bullish on your business. You would not think of selling. You absolutely would never sell. Don't even talk to me about selling. I do not want to sell. No, that's the time to sell, in my opinion. Now, let's not make it so black and white. I mean, there is an opportunity to be harvested, and let's not be blind, but that is generally the right time. And that's when you can command a premium. Yes, sir?
And should we use that line, one more approach? Absolutely never, not interested, but I'll still talk to you.
Yes, exactly. That's exactly what the question was, should we use that line, absolutely never, not interested, but I'll talk to you? Yes, a great way. Okay? But if I do talk to you, there'll be other people involved and so forth. So, always, my approach is anything is sellable. Give me the right price. It's just an asset, and that's what you want to say. It's just an asset. It's not my life. I built many assets in my lifetime. Give me the right price, sure. I'll help you grow this asset, and that's simple. Simple dollars and cents, buddy. Okay? That's exactly what I would say. Market timing, private capital marketplace, the M&A cycle goes in like 5-6 year cycles. So right now we're in a very robust M&A cycle. 2008, it was really horrible. So that's also a very key factor because cost of capital and other things come into play. Higher the cost of capital, lower the multiple. So you got age, business stage, market timing, 3 factors to look at. I doubt it that anybody can really align it perfectly. So I would not get bogged down. What I'd want to say is if you've got 3 years of uptick on your profit line, hopefully on your margin line and your cash flow line, you're probably a good candidate. If you've got this kind of stuff going on, you're still fine. It just depends on your business stage and where you are in life. But don't get bogged down with operator-specific issues. Gentleman I ran across, we had some payroll tax issues 2 years ago. My company is doing great, but until I pay these payroll tax issues, I really don't want to talk about sale. And I'm like, what does that have to do? What does Teen China have to do with apples and Columbia? Man, they're going to come in, they're going to buy your business, they're going to get rid of your liabilities, they're going to buy certain assets, take over your cash flow stream, your goodwill, your name. They're going to leave you saddled with your IRS debt, or they're going to pay it if it impacts them and reduce the purchase price, and that's it. Let's not get bogged down with operator-specific issues. Let me work on this system and that. You've got to really kind of look at an overall plan. If you've got the overall things in place, you're probably a good candidate. Okay, so next question before I go to the next slide. Buyers always ask me, Gower, what is the value of my business? What is the value? And I always smile and always say the same thing. What exit channel do you want to choose? What do I mean, exit channel? So what I'd like to tell you is you can actually pick your own price, okay? And it's not just one size fits all. So here's an example. If you have an internal buy-sell with your partner, you're probably dealing with asset value, maybe fair market value, and you're getting one price. If you've got an employee stock ownership plan, you're probably using fair market value and you've got a higher value. If you're selling as a recapitalization where a private equity firm bought 60% of your company, you're probably selling on financial market value, which is a much higher value. If you are really out there and want to really maximize, you're selling to running some kind of competitive process with someone like me, and you've got something called synergized market value. And I'm going to cover into what synergies really are in a little bit. But this value is much higher. So it depends on who you sell to will decide your actual exit price. And also understand, each one of these channels has their own exit-specific tax liabilities and exit-specific risks and exposures specific to them. So part of this is starting early and doing an exit options analysis to understand what are down the exit. There's multiple other options that I'm not showing. What are my exit options? How do they impact me? How many assets do I have? What are my personal and family goals versus my business and financial goals, and aligning all those together. And that's exit planning for you, by the way, okay? All right, so this is another thing that before I go to that slide, when we think about getting maximum value for our business, I think as entrepreneurs, we get really focused. We get really focused on revenues and profits, revenues and profits. But let me give you a much more holistic view, because this is how a buyer is going to look at it. So you got 5 transfers of value, starting out with asset transfer. So you got your working capital, hard assets, facilities, people transfer. You got key managers, employees, et cetera. These people need to be locked down, by the way, and we'll cover that in a little bit. Value, which is your IP, customers, suppliers, contracts. Momentum, increasing revenues, margins, robust pipeline, and opportunity. Target market trends, position, and growth potential. Now, I want to tell you something very key. Everybody is looking at your cash flow to form a basis for the future. Cash flows and your previous performance is historical. What they're really buying is the promise of tomorrow. So if you are not focusing here, right here, momentum and opportunity, okay, you're really leaving a lot of money on the table. And as entrepreneurs, so this is where I've talked about most entrepreneurial attributes or personality traits lead to value destruction and exit, but there's a few that are really good. One is using your own sales ability to convince the buyer on the opportunity and actually doing the homework around it, and that's where you're going to get the big multiple, okay? And also, you need to look at, when you look at your business beyond just, oh, I've got systems to do, you got to transfer assets, people, and value. And there are different buckets, and you got to prepare for them differently. Okay, so what increases value? Back to your question. All right. Business model, competitive advantage, barriers to entry, i.e. you've got some proprietary technology, licenses, not everybody can get into your business, useful life of patents, operating performance, management depth and breadth, kind of reading the slide. Now notice something. I don't have revenues, I don't have profits. Why? Because in my world, profits and revenues are prerequisites to the game. It is, let's talk about a home. It is the foundation and the roof. If you're buying a house, the first thing you want to do is make sure that there is a foundation and there's a roof. Revenues and profits. If there is no roof and no foundation, forget about it. Okay? Almost sounds like the Italian guy. Forget about it. So, forget about it. So, the point is, so when somebody is working with us and they're like, okay, back to the same example, Gower, $20 to $50 million in revenue, 3 to 7 million in EBITDA. We want growth 30%, 40% year over year. So we had 50 targets. We brought them down to 7, then down to 3. All of them have good revenue, good profit, good margins, and they're all growing about the same clip. So what would my buyer buy? They would buy based on exactly this. Who's got a better business model? Who's got barriers to entry? Who's got consistent operating performance? Who's got employee stability? Who's got good management? So forth. This is what's going to decide how much money you get for your business and why. So this is talking about what increases value. This is talking about what increases the value even higher. So now we're looking at reduction of risk. This is transaction terms. So yeah, sure, you want 100 million? I'll give you 100 million. I'll give you 5 million in cash, the other 95 million in an earnout. So they say, exactly, they say seller's price, buyer's terms. So transaction terms matter. Financial transparency, if they can trust your financial, you got audited financials, compiled financials, something they can hang their hand on. Remember, they're going to use this to finance their transactions, so they want complete transparency. Recurring revenue streams, customer diversity, you got contracts with key players. You don't have like handshake customers, you've got them under contract and things. That happens. Growth potential, the synergies, the target market growth, market position momentum, and then comes the financing leverage. Low capital expenditures, which I'll cover in a little bit, cost of capital and stable capital. So this is the formula that's going to push the value up even more. Okay, another very important slide. The entrepreneur's valuation versus the buyer valuation. Okay? So the buyer is looking at, it's a simple formula, benefit over risk. They want stable, sustaining, and improving revenues, margins, cash flow, and then profits. and on the risk side, they want reduced risks of all kind. So why is it that most businesses don't end up selling? Part of it has to do with what I'm about ready to explain to you. The entrepreneur has 3 different types of values. Now, you will probably not see this somewhere. This is my hypothesis, but maybe you can relate. First is the S value, what I call the sacrifice value. This is, hey, I started my business, okay? My kids suffered, I borrowed. It's my sweat equity in this business, okay? How dare you offer me $1 million? It's worth 20. Kidding me? Plus, it's 80, 90% of my net worth. It kind of makes us goofy, okay, as entrepreneurs. So it's what I call, it's a sacrifice value, but it's really sweat equity correlation to value. We're not treating it like an asset. We're treating it as our baby. It's our sweat equity. We started it. We're emotionally attached. So there's an emotional component to this, okay? Sacrifice value, big destructor. We're not in touch with our own reality. We don't get that way about our homes, and if we do, we don't get obscenely crazy. The realtor comes and does some comps and says, your house is worth $1 million. You think it's worth $1.3 million, but about 6 months in the market and a little banging on the head, eventually it sells for $990, okay? Why is it that we do that in our businesses? It's just because we don't have an asset mindset. Second, E-math is what I call entrepreneurial math, and it goes something like this. It's the cocktail napkin thing. We got an offer. Take a company, we're making $1 million a year. Our EBITDA is $1 million, and we take $1 million, and somebody offers us $6 million, 6x our multiple. Okay, we got making $1 million, $6 million offer. I do my math. Hey, I got about, between taxes and debt, maybe about $2 million. So I'm left with $4 million. And I'm going to take that $4 million, I'm going to put it in a bank account and get 3% on it. After taxes, I got $120,000. Whoa, $120,000 million I'm making today, and after all this and putting this money in the bank account, I got 120 grand? I'm not stupid. I'm not doing this deal. E-math, okay? As a result, because we are so focused on lifestyle replacement, our businesses are our lifestyles beyond assets. What am I supposed to do? I've got running a lifestyle at $1 million a year. Next day, I got to go run my lifestyle at 120 grand and work for somebody. And what's to ensure that I'm going to be able to build another business that's as successful as this one? $1 million is a pretty fair chunk of change. I'm not trading $1 million cash stream for 120 grand. Okay? But the reality is that business is worth $6 million. And the reality is you got to retire your debt and pay your taxes. So what do? Right? So that's the big gotcha factor. But other point is that we hold it too long. So we basically hold it till we go in our grave, or we hold it until the market comes down, and now we don't even have that $3 million, $4 million left because we just worked our business into the ground. You know, the new technologies came into play, and we get all emotional, and there's a time to build an asset and sell an asset. Okay? So again, big problem. The third element is, go ahead.
On the flip side of that, is there a proportion or a time the buyer is looking to get the money back in that?
Oh, absolutely. Buyers always looking for time and money back. So, I mean, if you just take it, I mean, it's very simple. I mean, they have a 6-year time frame to be able to get 100% of their money just to be able to pay you plus their return. Different industries go by different stuff. I mean, we've got guides that we look at, and I look at industry comps. I like to kind of develop a range, but I'm not interested in the top side. So one big difference between a business broker and someone like myself as an M&A advisor, I will never name a price. Okay? I'm an entrepreneur. I'm good at selling the invisible. So don't tell me that my business is worth $2 million when I could sell it for 20 by doing a great sales job. Okay, and we're going to talk a lot about synergies later. Okay, in my book, I've got a chapter on synergies, and I want you to really understand synergies. You don't want to sell your business on the basis of your cash flow. That's the business broker model. Hey, I'm going to get it out. No. I'm not interested in that. I want to sell it on the basis of opportunity. Opportunity that you realize. As a result, I got to understand what that is, and how we actually do it is coming in just a few slides. So let's talk a little bit about O value. O value is the opportunity value. This is, again, kind of what I'm talking about. Hey, oh man, if I had 2%, just 2% of my industry, man, we'd be a $2 billion company. Yeah, I'd be like, boom. Okay, 2%. That's all I need. Without any regard to, and that's why you want $20 million more for your business, without any regard to organizational reality, organizational capacity, the capital expenditures required, the increases in working capital required, you're not in touch with reality. I remember a quick little story. 20 years ago, I needed to raise some venture capital. I went to a venture capital conference in Seattle, and I remember sitting there. There's a VC on a panel, and he goes, you know, you entrepreneurs, I know that most of your financials are bullshit. We just want to know the magnitude of your bullshit, okay? So this is one of those. These guys, man, buyers come in, they're going to peel away the BS. So this 2%, BS, okay? They're going to say, show me the assumptions, how you're going to grow it, where's the money coming from, what's your capital plan, what's your capital structure, what's your financial strategy, how do you justify this. These guys are pretty savvy, okay? I mean, a lot of times with companies y'all size, once you sort of get over $1 million, you're dealing with a pretty savvy buyer, okay? Once you go over 5 million, they're going to get savvier and so forth. So that's the big disconnect with the entrepreneur valuation versus the buyer valuation. We're thinking very differently than the entrepreneur, than the buyer. So let's talk about, conversely, what increases risk? Performance, inconsistent revenues, flat revenues, declining order backlog, declining revenues, non-proprietary products, low margins. Hey, how about lower than industry margins? How many of you are actually even benchmarking across your industry? If you can find the right, depending on which space you're in, it's very important to kind of benchmark and to kind of develop sort of some metrics around how you do it. Bid type selling opportunities, big value reducer. Operational risk, concentrations I've covered, obsolescence, inefficiencies, and those types of things. This increases risk. Now, if I was to say, what decreases risk? You can say, hey, exact opposite of that. But that's true. But if you ask a buyer what decreases risk, they're probably not going to come up with these. They're going to come up with things like this: customer diversity, product diversity, industry diversity, recurring revenues, correct filing of copyrights, useful life of IP, barriers to entry, and things like that. So there's certain industry buzzwords you need to understand that you need to be focused on. So while on the slide prior, if you were focusing on this and then actually forgot about diversifying certain things and having certain things done properly, you're still not harvesting the right value. So you kind of come at it both sides of the equation. Okay, this is a very important slide, okay? So this is where growth can hurt value, and Katie, there's something in there for you specifically. Product mix impact on value. Number one, not all growth is created equal. So let's say that you are a lamp-based manufacturer, and you've got good revenues. You've got one of these adjacency strategies for growth. You think you should get into the lampshade business. You go invest, instead of investing $1 million in your core business, you go invest it in the lampshade business. You grow another $2-3 million in revenue. You're doing good. You go out to sell, and all of a sudden you find out that the lampshade manufacturers sell for 4.5x versus the lamp-based manufacturers sell for 4.5x versus the lampshade manufacturers sell for 2.5x. Now, are you a lamp-based manufacturer or a lampshade manufacturer? So either you're just purely on a return on investment basis, either your cash flow, the cash stream is going to be valued differently, or the overall value of your business is going to end up getting lumped and getting blended and going down. So not everything is equal. So let's talk about cash flow, and this is mission critical. It's very normal for you to have, let's say you have $5 million in sales, your EBITDA, your earnings show $1 million in profits, but you got no money. That happens to us all day long. You've got some high growth companies with a lot of profit going out of business. Why? Okay, because our money is sitting in working capital and is sitting in receivables, is sitting in inventory, work in process, and so forth. And we've got capital expenditures. EBITDA, earnings before interest, taxes, depreciation, and amortization, completely ignores working capital. okay? You're going to get it bought on the basis of EBITDA, okay? But the reality is that's not what the buyer is really doing to do their own calculation. They're actually looking at your free cash flow, because free cash flow is going to take into account your working capital, increases in working capital, as well as any capital expenditures that are required. So if you have something like a heavy capital expenditure business where every year you've got to do a bunch of this kind of upgrades and different things, or every 3-4 years you've got to upgrade your entire facility, your buyer is probably going to want to offer you a lot more. I mean, offer you a lot less, because they're having to dip into their pocket. So back to you, I'm going to pay you 6x, and I'll cut you a $6 million check. But if every year I got to spend $1 million out of my pocket for capital expenditures for equipment and facility upgrades, and that's over 5 years, that's 5 years of $5 million, I'm going to pay you a lot less, because I got to go borrow that money, okay, or dip into my pocket, lowering my rate of return. Versus, so one of the best emails I got was a private equity firm trying to contact me. Gower, we're looking for asset light, working capital light, innovation light businesses, okay? Meaning they don't want to invest in technology too often. They want asset light. You don't have to deal with a whole lot of CapEx. And we want working capital light, so i.e. a company that can sort of support its own cash flow and growth. So this is where the problem comes in. So if you've got a strong EBITDA, and you've got all this working capital and increases in working capital and capital expenditures, but you have not financed that gap between free cash flow and the amount of capital needed, you're out of business, period. And so that's where lines of credit and things like come in and kind of fix that gap. But the buyer is looking at this, you are looking at EBITDA. Even though they will pay you in a multiple EBITDA, if your free cash flow is not correct, your purchase price is coming down. So let's talk a little bit about CapEx impact to valuation. And this is some, go ahead.
Can you go a little bit deeper on free cash flow? Are you talking about like cash after debt service, or?
Yeah, so free cash flow would be literally the net cash they got. Often, I've seen two types of definition of free cash flow. A lot of times, they'll take free cash flow and they'll take increases in working capital, CapEx, and many people, depending on, let's not go exactly by the Wikipedia definition, many people will also pay post-tax money. They even take taxes out. How much money they've got if they need to reinvest in your business next year, just like you. A lot of entrepreneurs, we have working capital that's taxed. We are a flow-through company, S-Corp, made $1 million. By the time we get done in the state of Oregon, they thank us with 50-something% tax, and plus self-employment tax, and all of a sudden we're left with 45 cents on the dollar, and then we got to use that money to stopgap any CapEx or other needs that we may have. Yeah, I don't disagree, but the problem with depreciation is the non-cash expense, right? So let me come at it slightly differently. So when I said EBITDA ignores working capital, okay. So let's say we agree to sell for $6 million on $1 million in EBITDA, and our EBITDA ignores working capital, all this stuff. It's entirely possible, me as the seller, I can manipulate this game. I can slow pay my payables. I can fast collect my receivables, where I call the buyer and my client says, hey, 5% discount, pay me today, that kind of stuff. Slow pay from net 20 to net 50, okay? Stop buying inventory, reduce my work in process, start liquidating. The buyer pays me $6 million on that $1 million EBITDA. The $1 million in EBITDA is not going to change, but the assets and liabilities of the business are completely changed. And that's why working capital hurdles and working capital targets are there. Otherwise, the buyer gets completely hosed. So this is a classic example of, I don't disagree with you, but in reality, okay, EBITDA is really not a good measure to measure the health of a company. So why did EBITDA come into play? Only reason is because we needed in the M&A business, they needed some way to measure one company against its peers in an industry. So it's kind of, call it a apples to apples metric. But the reality is, I want to know, after all said and done, how much working capital will be needed, what capital expenditures will be required, okay? what my taxes will be, what will be my net, and is that enough to support the business? If not, I have to borrow more. I want to reduce your purchase price. Unless the opportunity is so great, I don't give a hoot. In that type of example, you really don't want to be dealing with a private equity firm, which is relying on financial engineering to do this. You really want to be dealing with a strategic buyer that's got a lot of deep pockets and they just don't give a hoot. You know? So, other thing is, and by the way, I don't know whether to answer your question, but we can sideline and have more conversation on free cash flow. It's one of my favorite topics. So this is where something that you can go home today and actually change the value of your business, okay? What happens is that every year we're making certain improvements in our business. So let's talk about capital expenditures. What are they? It's basically the money we spend on the fixed assets of our business or to improve and upgrade the fixed assets of our business. So what's happening is that every year we've got these maintenance capex. We need to, whether it's computers or machinery, or if you're a restaurant, you've got to upgrade all these different elements, or etc. Things repairs, things break down. Okay, and then there's growth capex. You want to add a new room to your facility. You want to rehaul the restaurant, all that kind of stuff, or some other kind of business. What ends up happening is that the buyers come in, they want to say, what's your maintenance capital expenditure versus your growth capital expenditure, okay? And you are running a lifestyle business, or maybe if you're running your books clean, doesn't matter. You've got everything lumped together. The new carpet you bought for the new room, that was not maintenance. You just made an investment in your business, but you marked it, and you're in the expense-oriented mindset. You're just going to run it through the company and kind of get the EBITDA down because you're trying to get your taxes down. You take a deduction for it. Over time, you forget what you've done, okay? And it shows that you've got all these maintenance capital expenditures, and what the buyer wants, and they're actually, most of them are growth-related. Maintenance capital expenditures are an expense. Growth capital expenditures are investment. And it's an old buyer's trick. They'll try to take your growth capex and try to claim that they're maintenance capex. Another way to look at it is, let's say that you don't have equipment. You're a technology company, and you want to develop a new software or want to majorly overhaul the software to increase its adaptability. So you hire 10 new programmers and all this money and machines and computers and subscriptions and all this stuff that you did. That's really not a maintenance expense. Ideally, you need to be tracking them differently, at least to show the buyer what your real profitability is. It's very easy for us to take a company making $1 million and turn it into making a company $200,000 and then complain that we're not going to get enough money for it when we're actually making $1 million. Why? Because we just didn't track it that way. We're not thinking that way. And then by the time we think that way, it's entirely too late, and our CFO doesn't remember, or he's gone, or maybe we don't have a CFO, maybe it's just us, we've got a bookkeeper, and we certainly, remember, we're firefighters. We can't remember anything beyond 2 weeks a lot of times when it comes to finances. Literally, I mean, there's so many expenses running through. I don't know about you guys. Man, it's hard to keep track of things. So it's just, let alone go back and compile 3 years worth of history to kind of show some, hey, this is what's happening to our margins and cash flow. So this is a key factor of how you account. I would actually suggest you create multiple accounts, and at least, regardless of how you run your existing financials, just create an account that marks it to growth as well, so it kind of shows the buyer, hey, of the $1 million last year, we spent $400,000 of what we qualify as growth-related reinvestment, even though we expensed it. So if you want to take it over without any of that, or if we didn't do it, we would have been just fine, and we would have had $1 million in EBITDA. All right, so this is another one. A lot of times entrepreneurs operate in a cocoon. I got $1 million, I want $6 million from my company, and that's it. They don't understand where the purchase decision is coming from. From a buyer perspective, they've got an investment criteria. They've retained someone like myself. They're looking at a targeted industry. They want a company with a competitive position within that target industry. They want historical performance, realistic growth, and so forth. And here comes in, they'll be like analyzing cost to grow, cost of capital, CapEx versus cost of capital. What's the working capital required? That kind of helps them determine and model out their return. Synergy benefits to the buyer. This is very important. So let's talk a little bit about synergies. When I buy a company, first thing I'm going to do, let's say I'm some kind of manufacturing business. I'm going to get rid of the accountant. I'm going to get rid of the CFO. I'm going to get rid of the accounts payable clerk, accounts receivable clerk, whatever it may be. I'm going to get rid of a bunch of different things. I'm going to consolidate things. Those are called cost efficiencies, cost synergies. Then, depending on whether I did a vertical acquisition or a horizontal acquisition, i.e., that I got different set of customers versus the same type of customer, I'm going to cross-sell my existing services to them, or I'm going to get a new customer base and I am going to sell to them, or I'm going to take the company I bought and sell them somewhere else. However it goes, you've got revenue synergies. Okay? It could be that you absorbed, it's an absorption model like Apple. You buy a technology, roll it in, the company's gone, next thing you know, Siri is alive on our iPhones, right? That basically revenue synergies. Or it could be something like a revenue valuation synergy. It could be like an arbitrage synergy where a public company buys you, and next quarter they roll your revenues in, and they bought you for 6x, and they trade for 17x on the stock exchange, right? So the synergy benefits to the buyer are also very, very important. How they're going to run your horse faster, better than you. Then they're going to look at integration. Does the culture fit in? How that works? What the risks are? Okay. Last thing they want to do is, if you've got a very entrepreneurial culture that cannot survive in a bureaucracy, they don't want to make good money bad. Okay. Often that's exactly what happens. And then they're going to come to a valuation decision. So, which is kind of leads to the next thing. Another thing that you need to really look at is people equals cash. Okay, I really like my people. All right? I mean, I've got people that have been with me for a long period of time. I'm a very loyal guy. So this is always difficult, but here's what's going to happen. Good 30, 40, 50% of your workforce is going to be gone the next day. And they're going to end up costing you a lot of money in some cases, not all cases. Okay, so you got new employees, non-performing employees, underutilized folks, lazy people, overpaid people, plus the hidden cost of paycheck of up to 40%. So if you've got a $3 million payroll and this equates to 25%, take that, multiply that by, well, let's say 30%. That's 900,000. Take that by 6. That costs you, $5 million plus, right? So part of it is really optimizing before you ever go out and sell. You really got to adjust to reality. And I always like to tell the story of an assistant, personal assistant that started with a customer of mine that started 20 years ago, and they ended up starting at 30 grand, and with cost of increases and loyalty kind of bonuses, they were at $87,000 by the time they ended up getting sold. And the first thing that I told them, she'll be the first one to go, and that's exactly what happened. They basically came in. They don't have to take all the employees. They're buying assets. They did not take over that employee. And she was out of a job. And the reality is that person had depressed the EBITDA line by $50-something thousand, costing my client $300,000 in earnings, plus the loss of a job. I had suggested we cut the assistant $100,000 severance package, and it would have still given my client $200,000 more. So the point is, we got to be open to reality of what's about ready to happen, okay, while balancing our desires and needs to do the right thing by our employees. Sometimes, by doing some things up front, we may do the right thing, the entrepreneurial thing. So this is a key part because there's a multiplier effect to everybody that's underutilized. If you've got a lot of underutilization happening, maybe consider outsourcing it. Have some good control risk type outsourcing third-party agreements in place. You want to clean up your house before you ever go out in the market because you're going to leave a lot of money on the table. All right, so exit horizons. 3 to 5 years prior, lay the foundation. 1 to 3, increase value. 0 to 12, clean up. It'll take you between 3 to 12 months. Average is about 9 months for an average American business to get sold, okay? If you're thinking anything beyond that, and one of the reasons we start dating the first girl that comes around, okay, is simply because she's there. She was available, she's ready to party, she's ready to be happy. And that's exactly the problem. We don't want to spend and do the heavy lifting. We have an asset. We cannot take the first contract that comes on our house without even looking at what the house is really worth or putting it out on the market. It's just not, unless we really know what that contract, what that value really is. So let's talk about what needs to happen, reduction of risk. So I have a little cheat sheet because there's some things that I may or may not have here with me. But so let's start up talking about documentation and protection of IP. Entrepreneurs do a horrible, horrible job of realizing how much their intellectual property plays into the value of their business. So they have everything for their previously worked for an employer, and they did not have an assignment agreement, and they basically left and kind of continued to work on the same kind of technology or using the same kind of processes in their business, and the previous employer has a claim once they find out you're for sale or you're dealing with litigation once they find out. Or it'll be something like a gap in the IP title chain. You've developed technology, and along the way you did not get a work for hire agreement and so forth, and you've got all these different contractors out there that have touched it that are making claim that they actually that they have some claim to the IP. Or it could be incorrectly filed trademarks. It could be non-optimal patents, improper quality control, ineffective standardization. Those are also like key factors. So you really got to go look at residual life of copyrights, how you're, a lot of times we've got patent issues. We're not looking at, this is a key, by the way, patents, or why would we, international expansion, we're never going to go international. Why do I care? You care because the company that buy you may want to take your product on an international basis, and if you've not taken care of certain international patent standards and not dealt with that issue, you just seriously minimize the value of your business because you did not have your eyes open around your IP. So it's a very, whether you have any plan of doing so, I would seriously take a look at that. Contracts and documentation. Got to button up everything from key employees. If your employee is your biggest asset and they go home tonight and may never come back, okay, you've got a huge problem. So here's what happens is a lot of times the earn-out surprises is we've got key employees. We really want to lock them down before the sale to keep them performing, during the sale so their focus is on the sale, focus is on the company, and after the sale, during the post-closing obligation and the earn-out stage. Okay? Last thing you want is you're sitting on a beach somewhere and 30% or 40% of your revenue depends on 2 key employees, and you're getting this call saying, you know, John and Mac, they kind of left and walked out. And you just had oh, by the way, you know, the 20% escrow, and you're going to lose that, plus we're going to claw back another $2 million from you. Or your earn-out may not materialize, depending on what the situation is. So it's very important to lock these guys down. Or it'll be something like suppliers where you've got, and by the way, I have ideas of how to lock them down, sideline conversation for anybody that wants to know. Suppliers could be hard to replace suppliers. You need to put, they're hard to replace, and you've got a concentration. You gotta get them on a contract, but make sure you got some kind of flex clause, something flexible that if you want to terminate on your side, you want to sort of get your cake and eat it too, ideally. Handshake customers and non-assignable contracts, get them under contract. If you can't, in many industries, it's purchase order to purchase order. Do the best you can to get them under contract. If they don't, understand that that's going to reduce your value. Missing contracts, critical licensing agreements, leases, those types of things. Again, with leases, have some flex option to terminate from your end if you can. Financial transparency, commingled accounts, improper revenue recognition, personal obsolete assets, inaccurate records, lifestyle records. We don't understand our own profitability. Focus on spending 10, 15 minutes every month to recast your expenses. You will forget. You will run things through. Your bookkeeper will come in and make journal adjustments that make no sense, and if they do, just track it. It doesn't take much. Just have somebody just create a spreadsheet, let's set up a basic system for what the add backs would be, and let's add them in. Other things is you'll get surprises. Okay, if you're not accruing wages, vacations, salaries, things like that. So if a company buys you 6 months in, Okay, you got your money, and while you're on the beach again, you get the call, oh, you know, when we're reconciling the final balance sheet, you weren't accruing the vacations, the sick days, and all these things, certain things, or pension deposits and things, and that equates to 300 grand reduction on the purchase price, okay? Those kinds of surprises are going to come out simply because. Normalize CapEx and working capital. If your facilities are completely outdated, bring them up to date. If you're not tracking them properly, please track them properly. I mean, these are important elements. Normalize your payables. If you are speed paying, bring them down to a normal level. You don't win by, you know. The point is the buyers are going to look at 12, 24 months prior. So if you have little to no payables, they want your receivables, they'll take little to no payables, but you could have given them normal 30-day payables. Why are you speed paying them? Plus, you're probably dipping into your line of credit, increasing your interest expense. You don't need to. Just be reasonable. Don't play games. But other point of is, receivables-wise, you really want to incentivize people not to have anything beyond 30-day receivables. If you do, collect them. It's just know one thing. If you're being lazy, complacent because you've got good customers, they always pay, well, guess what? That's going to cost you a lot of money one day. Inventory, take an honest assessment of your inventory, normalize it. If you've got a lot of excess inventory, start liquidating it. Get it to a normal lean amount. I'm not saying don't have a decent par. I'm saying clean it out. Okay? If you got a lot of inventory that's sitting, that cannot be repurposed, get rid of it, write it off, write it down, get it out, run clean companies. It just will help you later on. Reduce concentrations. So we've talked about concentrations. So let's talk about what if you have a concentration. Some of you have big customers. What are you going to do? Go fire your customer? If you got a big customer doing more than 20% of your revenue, you've got a problem. So if you do have that situation and a buyer comes in, first thing you want to tell them before the letter of intent is ever signed. Second, do a financial analysis that if your big customer leaves, what happens? Big customers use big resources, a lot of employees, space, cost of goods, materials, other things. So it's not like just on the revenue line, on the expense line, you would have to displace some employees, let go of some space, you know, utilize less resources, deploy them elsewise, kind of do a net analysis and have that ready before you list your business for sale for the buyer so they understand the true financial impact of what happens if somebody was to leave. Okay, here's some classic examples of value enhancement. Improve cash flow. We've talked a lot about inventory, you know, getting control of purchasing and all that stuff. I mean, I could just teach a day just on that. But focus on consistent performance. What you don't want is feast or famine revenues, like this and this, zigzag. You want to try to go on an even thing. Do not get unrealistic with your growth. Oh, I'm going to do 10 million and I'm going to do 15 million. You know, I'd rather you say I'm going to do 4 and 5. Just have tiers to success. A lot of times we try to do too much and then we just fall flat like that, reducing the value of our business. Okay? Sometimes it's unavoidable. Optimize your tax impact. This is the time to do your tax planning, at least a few years prior. Develop a successor. Change your role. I call it onboarding and deboarding a 747 at 30,000 feet. It's really hard to give up control, bring somebody, let the bird fly, deal with it without micromanaging them. Allow them to make mistakes. Every time you walk into the business, once you reach a certain revenue point, every time you walk into the business, okay, you are hurting your own self and your own valuation. I like to tell clients, work remotely. Manage your business strategically. Stop getting involved in the tactics unless it really is mandatory and necessary. But what I want to hear is that you're working remotely. And when the buyers come in and they're talking to the employees will be like, yeah, Jack's never here. And that's the kind of business they want. Jack's never here. Yeah, Jack comes into our board meetings, our employee meetings, but Jack's never here. I hear he plays a lot of golf. Always go in shorts, okay? Convince your employees that you are absolutely the least valuable player there and you've accomplished a great value for your business. Okay, and get in that mindset. It's just an asset, guys. It's just an asset. You can build another one. Exit options. Conduct an exit options analysis. Understand deal with somebody, whether it's me, whether it's somebody else, figure out what your exit options are long before. A battle's won before it's ever fought. Net proceeds, you need to look at the makeup of your liabilities, what's happening, let's kind of clean up, understand what your net proceeds could potentially look at. A lot of times it's too late to deal with this after the fact. Align your stakeholders. If you got a VC, private equity, their agenda is almost never the same as yours. If you are burnt out and ready to exit, they don't give a hoot. Okay? They don't care. They're again, asset-oriented mindset, return on investment. You may have family members in the business, other shareholders in the business. People are talking minority shareholders. You may have valuation disputes. Align people around your valuation before you ever go out on the market. It's a big disruptor of value. Okay, it's a classic example of what I do in companies. Starting with creating times, developing talent, focusing attention, aligning tactics, metrics, controls, performance standards, automating systems, processes. I mean, it's kind of just classic value enhancement stuff. The process begins something like this. We need to kind of understand and do a complete audit on our own business and doing a reverse due diligence exercise. We want to understand everything and understand what's going on, analyze those findings. And then this is the key part. Unlike, hey, this is kind of what's wrong, we want to understand the time to exit. So you say, hey, I want to exit in 3 years. The cost of these various findings or various initiatives you're going to come up, and what is the benefit? So it'll go something like this. We've got something that could increase our value by $1 million. It costs $200,000 to do, but it takes 5 years to do it. It's automatically off the table because your exit time frame was 3 years. It could be another one where it says, hey, it cost me $20,000, but it increases my exit value by $200,000 and it takes me a year. That initiative is sequenced to the top. Classic against cost versus benefit versus time to exit. And then it's a question of implementing and monitoring and kind of keep yourself on track. And ideally, that's what I would have you do at this given point in time. Ideally, I would want everybody, if they could get tactically out, to actually do this. And this is hard to do and not easy. Okay, of this session, this is probably one of the most important slides. So if somebody needs to sort of shake this off, I need your attention on this one. So somebody asked me here, they said, how do I increase my purchase price and so forth? Who was it that asked me? I think you were talking about increasing purchase price, or were you asking me? I think somebody over there was asking me. So I've talked a little bit about synergies. So when I'm dealing with clients, I'm presenting 3 different types of EBITDAs. First is a EBITDA as it exists today. The second is a recasted EBITDAs, which most financial advisors business advisors would present. And it's basically we add back depreciation, amortization, interest expense, and kind of have that, okay? I like to create a third line of EBITDA, what I call synergized EBITDA. So once I know who the buyers are, I'm going to go and look at their business. I'm going to try to understand, are they looking for cost synergies? I'll understand what my cost synergies would be based on their business. I want to understand what their revenue synergies could be. And I'm going to try to take a stab at what their revenue synergies are. I mean, this is not an exact science. I'm probably wrong, but I want to at least take a stab at it. And I want to understand if they're playing an arbitrage valuation synergy and so forth. And based on that, I'm going to take those synergies, discount them, and have a third line. So it could be $1 million as is EBITDA, $1.4 million recasted EBITDA, and a 2.5 synergized EBITDA. But the difference between $1 million times 6 and $2.5 million times 6 is huge. I think it's 15 million versus 6 million, I think something like that. My brain's not working math-wise. So all of a sudden, what I have done, okay, instead of being kind of that business broker mindset, what I've done is trying to shift the mindset of the buyer from a multiple of X to a multiple of Y. And that Y is opportunity, okay? And not just opportunity that's, you know, some hokey-pokey story. This is, I'm saying, Mr. Buyer, this is what, in my opinion, in our opinion, what synergies we think you may realize, and they're like, oh, no, it's not too much. And I'm usually, when I'm talking to them, I'm like, so what are you going to do with this business? And they'll be like, oh, well, we're thinking about using this, and we could probably deploy this in our supply chain. And I'm like taking a note. I'm like, I'll remember that for later on. And then they'll say something on. So when I was initially kind of dealing with the buyer, we're kind of keeping a track of how it could synergistically benefit so we can quantify later, add it. So when we're talking like, you said that it would be based on your supply chain, you could put it into your existing products, and this is kind of our stab. It's going to be something, and then it's a battle. They're resistant, but eventually if you've got a good advisor, generally you can get them to give a little bit and at least shift the dialogue and get their mind thinking away from your cash flow versus more to the opportunity. And it's easier to do when you've quantified synergies rather than just hype. Next case, you got to build a business case. This concept of, remember what I said? Buyers are investors. We don't view buyers as investors. Why not? Remember when we were out raising capital for our businesses? Man, how many hands did we have to go shake, and how many no's did we take before we got to that first yes? Because we knew that going out and raising capital is extremely hard. That's what makes us entrepreneurs. We got to get out and not take no for an answer. We got to sell, guys. These guys are investors. So if the complacency that the entrepreneurs do, oh, they'll come to me, and when they do, yeah, okay, if you're gonna go down this road, you need to sell. You need to lay out a business case, an operations plan. Basically, what you want to prove to them is that you've got a realistic growth plan and how you're going to sustain your margins or potentially grow your margins, grow your top line, and grow your free cash flow. That's what they care about. So you might as well lay out a real plan, focus on it, okay? Because this will be one of the biggest sale you will make in your lifetimes. Okay, so don't just say, okay, well, it'll happen, what'll happen. You're leaving a lot of money on the table. Leveraging blemishes. So we got a lot of boo-boos in our business. Everybody's got them. Okay? So a lot of entrepreneurs choose not to disclose them, and then it comes to bite them later. Leverage them. Nobody wants to buy a perfect company. Buyers are opportunistic. They want to buy a company with great growth potential. I never said they want to buy something perfect. Because if they see imperfections, they feel they can get the price down, or they have, when you've told them up front, they're going to give you a price accounting for those blemishes, but in their mind, they're getting a good deal, a good value. They're opportunistic. Leverage your blemishes. If you've got them, my thought is always identify and rectify. If you cannot rectify them, disclose them at the LOI stage before you ever sign a letter of intent. And this is very important. I want everyone to remember I said this. One day, each one of you, I hope, sell their business, okay? For your sakes. Or at least transfers, have some exit. When you do, when you're signing that letter of intent, just think of me today and what I said. The moment you sign that letter of intent, only thing that can happen to you is that your purchase price is going to go down. This is where a good advisor is really needed. This is all about preservation of purchase price, because the moment due diligence begins, everything is going to come out of the works. Remember we talked about the difference between valuation and worth in the first session? It's like they're finding termites behind the walls, and for every termite, they want to reduce the stuff. So let's, one, disclose our termites up front, and secondly, you need an advisor that can give some pushback. And that's why you want multiple buyers around anyways, ideally speaking. Other things that can happen is that a lot of entrepreneurs take letter of intent as the end-all. So let me tell you, there's only two parts of a letter of intent that really matter, in my opinion. One's confidentiality or binding, confidentiality and exclusivity. So you're going to say, hey, this all stuff is confidential, and for 4 months, I'm not going to shop my deal. But outside of that, all you have done with a letter of intent is agree to negotiate a purchase and sale agreement in good faith, okay, and permit due diligence. That's it. That's all you have done, okay? Nothing else. So LOI does not mean jack. It just doesn't. Other thing is, one buyer is no buyer, and I've covered that earlier in one of our questions. If you're not running a competitive process, you're not harvesting proper value. Other thing that I want you to look at when I was talking about a purchase offer with some C4 attached, think of it as negotiating price versus negotiating a letter of intent. If you look at the letter of intent, the letter of intent is going to have some of the C4 explosive elements. So do not be swayed by price. Negotiate letter of intents. Do not negotiate price. Price alone does not mean anything. A letter of intent with proper terms and consideration will mean everything. Other element, value is calculated, future earning potential, reduction of risk, and price is negotiated. These are transaction terms, allocation of risk, financing terms, buyer motivation, cost of capital, so forth. All right, important slide. Most entrepreneurs are here. They're focused on getting great price and getting the buyer. The real opportunity is here. 1, 3, 5 years prior. Value enhancement and preparation. This is where you're going to make your money. But we have zero focus in this area. And we go to these, oh, by the way, growth seminars are great, but the growth seminars operate in a cocoon. Okay? It's great to grow your business, but if you're not looking at cost of capital, CapEx, and your future valuation and what your future cash stream is going to look like depending on your growth model, you're kind of growing for growing and you're not spending your time efficiently. So, I mean, I think that growth seminars and things, growth needs to be put in context. Second part is the moment the letter of intent signed, sustaining purchase price is the other part. Notice this box is bigger than this and this box is bigger than this. There's a reason for this. You've got to sustain the purchase price. Okay? Getting an offer does not mean anything. Sustaining the purchase price of what you collect at the end of the day. And I will also tell you, no matter what your purchase price, there is a 90% chance, and this is conjecture on my part based on 20 plus years, whatever your purchase price, I doubt you'll end up collecting it. Okay? Especially unless you've prepared in advance and really have got a very clean company. There'll be purchase price adjustments and working capital adjustments and tax adjustments and, oh, you didn't get me a tax clearance certificate from the state and these accrued vacations, and they'll keep coming down. So now I'm going to tell you the biggest value destructor of all. The biggest today. The biggest value destructor of all is the entrepreneur's mindset. And they ask themselves this question: am I ready to exit? If you have thought of this, that is the ultimate reduction of value, or the kiss of death, as I'd call it. Am I ready to exit? So what I'm suggesting is that you create a new department. Here's the functional areas of your companies: finance, operations, leadership, strategic, and so forth. I'm saying add a new department, and it looks like this. What needs to be happening before the exit decision ever enters my mind department? Okay? So if you're thinking, most entrepreneurs think, am I ready to exit? No, I'm not ready to exit. I don't want to be dealing with Gower. What are you doing, guys? Okay? You don't want to be doing this stuff at the closing table. This stuff needs to be happening long before you ever think of the word exit. Ever. If you're thinking of the word exit, you already got motivations. You're getting burnt out, stuff. And I'm not saying it's too late. There's still stuff that can be done. But the real value creation happens when you're simply not ready to exit. Okay? So what you need to be thinking about: who would buy me? Why they would buy me? What is my baseline value? How do I increase that value? My time frame for exit? What's needed for me to exit? And who will help me? Those kinds of things is what's going on, what should be going on. And I'll come back to that slide. So quickly, just a quick, for me, we provide exit maximization programs 3 months to 5 years. We coach, we grow, we prepare, and if you're ready for sale, we provide representation for qualifying companies.
My name is Sharon Soliday, and I'm the owner of the Hello Foundation. We're a niche staffing agency that works with speech pathologists and occupational therapists. And I would recommend this session to anyone who's not even thinking about their business being sold at any point. It was an incredible learning experience that I'm glad I was here. Oh my gosh, I have a cramped hand. I was writing so fast. It was just constant information about what to be aware of and what to think about, and sort of the sand traps that other business owners have fallen into, and how long you need to be thinking about things in advance that I'd never even thought of. We had actually been approached by a company to purchase us, and so I had some familiarity with what that process would be. I would have benefited greatly had I had this in advance, even though I sort of, by accident, I think ended up making the right decision. Well, the best thing he did for me is provided an analogy, because of the 30 people in the room, we all have different kinds of businesses, some in manufacturing, some service, and so to have him be able to relate it to, okay, you're buying a house or you're selling a house, this is what you're thinking about. It's something everybody could relate to and maybe have had some experience with, but at the same time we could translate it to our own businesses. So I greatly appreciated the analogy component.
Yeah, so my name is Augusto. I own a coffee importing business. My family grows coffee in Brazil. We import it, roast it, sell it. The name of the business is Nossa Familia. We have about 15 employees and are hoping to about 1.5 million in revenue. Part of the presentation that was really good is a lot of times as business owners we're thinking about growth, and it's dangerous not to think about the bottom line. So I've been really thinking about growth and bottom line, but there's a lot of other things that add value to the business that he brings up that are really good points, and I think important to think about: working capital and all sorts of things that even if you don't want to sell, like I don't want to sell right now, but I should be thinking about now because it'll increase my value now and it'll increase the value of the company if I ever want to sell.
David Butler. My business is Easy Media. We do social media for apartment communities nationwide. I'm the CEO and founder. I think the big thing is he was an entrepreneur himself and in EO. So speaking from experience like we do in EO a lot, that he's been there, done that, he's exited himself and brings that knowledge to the table is really fascinating to listen to him speak. I think he's able to simplify it, but then when you have questions, he's able to explain it in layman's terms rather than fancy jargon that you might not understand, I think is probably the biggest thing. Well, I think he's able to speak really generally, to be able to speak to a lot of different audiences of different companies, right? But then it seems to me that he has experience that when you provided with a really specific scenario, that he has the experience to address that, those concerns and topics and how to explain things specific to that issue.